While there are many ways to fund startups, an entrepreneur may decide to raise money to help grow their business. There are several reasons why an entrepreneur may want to take capital. This comes in many forms: seed funding, angel funding, venture capital funding, early debt, convertible notes. Before you begin, ask yourself if you're ready.
Some advice I would give to entrepreneurs considering equity round would be, are you really ready to take investment? So the clock starts the minute you take outside investment, and that is the exit clock. So when are you going to return the investment dollars back to the investors you took the capital from? So are you at the right stage in time to have that 3 to 6 year window in which you can return that investment funding?
So, why take funding? Your business may require a lot of capital to bring its technology solution to market.
There are a couple common reasons entrepreneurs will want to take capital for their business. The first is if their business is capital intensive. So this is often with companies that have pretty significant technology investments they need to make. So this could be therapeutics, semiconductors, medical devices, things that will require a fair amount of capital to get technology commercialized. So using outside capital to help overcome that capital burden is one reason. The second would be to scale quickly and to expand fast. So often startups are about how fast you can execute. So if a startup can take outside capital to grow faster and to really gain market dominance, that would be an important reason to take outside capital.
A third reason to take capital is that the problem is compelling and the solution is promising. But it may not be clear yet how much technology or scaling investment will be required.
There's some common mistakes entrepreneurs make when they're trying to secure equity and investor financing. The first is that most entrepreneurs underestimate how much time it's going to take to raise an investment round. So while in my experience, occasionally you can raise a round in under 3 months, you have to plan for about 6 to 12. So it does take time to build investor relations and to put together an investment group to complete a round. The second is being realistic about market terms. So understanding what is your company worth, what are the general terms of the deal.
As a company grows, finishing its minimal viable product, securing early customers, or demonstrating compelling results, angel and small institutional funds, micro or seed investment funds, will provide capital to help a company prove out its next series of technical or market expansion milestones. After a company has proven it can scale and has the potential for significantly higher growth and market penetration, later stage rounds of venture capital may be raised.
For entrepreneurs working with their first investors, the most important thing is that entrepreneurs are transparent. So what I mean by transparent is that it's really easy to communicate the good things that are going on in the business. You want to celebrate, share your successes. But it's often scary for entrepreneurs to talk to their investors about things that are not going well in the business. So if they've had a setback or a team member leave or a customer churn. And those are hard things that happen in almost every startup. But it's important that you communicate the setbacks with the investor because you might need further help from that investor and they might be able to help.
Equity funding can occur at any stage in a company's formation, but it is often reserved for when a company is taking more than $500,000 in capital. Equity funding involves the exchange of company stock for cash. Most venture investors are looking for an exit from their investment within a 4 to 7 year time frame. For entrepreneurs starting out, selecting the right funding mechanism and funding partner is extremely important.
As an investor, I love working with entrepreneurs. That energy and drive to create these large companies and have great success is really something that drives me to work hard on their behalf to help give them the capital and the resources they need to be successful over time.
In other words, raising money isn't just about capital. It's about networking, connections, advice, and experience.
One of the reasons I really love venture investing is the ability to help entrepreneurs achieve their success and their dreams. It takes capital, it takes a lot of resources and time to help a startup be successful, and being part of that team as an investor and as a mentor advisor is really an important role for all venture investors with the companies they fund.